Traders. So, how do hedge funds use quant strategies in their own businesses? That's what we're going to delve into here in this episode number 19 of the Independent Quant podcast. I'm the host and founder of the Independent Quant, Luis, and I help traders turn their trading ideas into algorithmic strategies. Now, I'm a trader just like you. I'm not a financial advisor or a financial professional. So, I know nothing I say is a recommendation or what you should do with your accounts or how you should trade your accounts. This is a conversation trader to trader. So, with that, additional disclosure that I also need to make is that this episode is purely the product of my research into hedge funds. I have not worked for a hedge fund before. So I am confident in all the information that I'm about to share for you. It's come from reputable sources, from everything from business schools to just good financial information or institutions that share this type of information. With that, I think one of the big surprising things that maybe not surprising about this whole process is that hedge funds really don't use strategies that are that much different than what we have available to us ourselves. So I think that's very uplifting that, maybe they may have more complexities to how they implement each one of these. But what we're going to talk in this episode is the role of the quant strategies at hedge funds, the most common quant strategies that I've been able to find that quant funds use, risk management, and how we as retail traders and professional traders can apply these strategies in our own accounts. So the role and benefits of these strategies within the hedge funds is really identical to for us. It's removing emotion, the ability to process vast amounts of data quickly, optimizing risk management, and trading multiple assets. I've talked at length in many of the other episodes as to why we would want to be algorithmic traders or quantitative traders. And we find that, that's exactly the reason that these hedge funds do it. And that really shouldn't be too surprising, right? Why would it be any different for them than us? So with that, if they're using it for that purpose, then what are the most common strategies that they're using? Now, I always start off with this one to kind of more get it out of the way because in all my research and all my just exploration of using this type of strategy, it tends to be very well funded and large institutions that can do it. And that's statistical arbitrage. That's when you're using pairs trading to buy an underpriced asset while shorting an overpriced one. It takes, from everything I've read, it takes very powerful computers that are co-located with the exchanges or not co-located in the same building, but as close as possible to help with just the speed that you need to be able to do these transactions. Everything I've read for retail traders, it can be exceptionally difficult for us to do that. The infrastructure that we need to have to be able to achieve these strategies can be substantial. I want to explore that concept more. Many of you know what I do for a living is I'm a solutions architect, project manager, product manager within the IT and kind of data science space. I build IT infrastructure to run business intelligence systems for companies. And I'm curious if, as much as the cloud is becoming more and more powerful and more accessible for people, if that's going to open the door for us to be able to do statistical arbitrage, because I can create an entire back end trading system that runs in a data center that is practically next to a a an exchange. I'm curious to see, in the next couple of months, next couple of years, as I kind of continue to grow this with you, if that's a possibility that comes up. I can't imagine that these hedge funds are not using cloud technologies. One of the big benefits of cloud technologies and why I get contracted to migrate these companies from legacy systems onto the cloud is the cost savings are significant. The operational capabilities are enhanced. There's a lot of good with going to the cloud. There are some risks, of course, just like everything in life. But with me contracting with these multi-billion-dollar companies and small and medium-sized companies to implement cloud technologies, I just don't see that something like statistical arbitrage would be beyond the reach of us, the regular, smaller trader, forever. So more keep posted on that. I think that's something that I'll keep diving deeper and deeper into and see if that's something that could work for us. The next strategy is market making. Now, there are market makers, and this is an SEC regulated profession. You have to become a market maker. So here is what market making is. I use this term because that's what I found in a lot of my readings. I think what they're trying to dance around is really moving the market and getting good buy and sell orders on both sides. So they're putting simultaneous orders in. For those of us that have been trading for a while, hold this belief that since these large institutions can see the order book, they manipulate the market price so that they could take out our stops, close their orders out, open their positions or close their positions. And this is where this term of market making, at least that's what I think is being used. I saw it pop up in more than one of my readings because actually market manipulation is illegal. Like they're not supposed to do that, but we all know it kind of happens. Not kind of happen, it happens. So that's one way that they can use their algorithms is to come get our orders and close things out. Something that's probably beyond the reach of us as retail traders. And I say probably because if you're trading a very thin market, you could have this influence on the market, meaning if the liquidity of the market or the time frame that you're trading is smaller than the position size that you're taking, you could be having this effect on the market that you're trading. Yes, liquidity in the S&P 500 in the millions to hundreds of millions, tens of millions, whatever it is each day. But if you're trading in a 30-second time frame and dropping 50 contracts, I'm going to believe that you're going to have a similar effect of like this market making, which I think again is an improper term. I think it's just manipulating the market. But a lot of that now you're looking at smaller profits per trade. It's low volatility. You could get yourself in some trouble, I think, using this type of strategy. But this one, I don't think is be one that we'll explore here at the Independent Quant. I don't think that most of us have an interest in this. Now, another strategy that's used extensively is trend following. For those of you that been following along this long with me, know that I am an avid trend follower. My favorite instructor was Bob Dunn. May he rest in peace. He turned me on to trend following. And this is looking for those momentum strategies that you jump on to price as it's moving in a certain direction, be that a bullish market or a bearish market, and riding it till you determine it's time to come off. Some trend followers, like I was taught, simply arbitrarily move their stop loss to capture a certain amount of the profit that's been achieved, while others are using moving averages, they're using relative strength, they're looking for indications that that trend is coming to its end or has completed. So it's one of the most popular strategies out there. It's made many a millionaire. In some respects, dollar cost averaging is a trend following, not really, but it is kind of like a trend following strategy in the sense that you are riding the wave of the market. The thing with us as trend followers is you are looking for the first indications of a trend being developed, jumping on that trend, and then getting off at whenever you think that trend's expiring. So it's good to see that, yes, that's a lot of what's happening at the hedge funds from all my instructors that have had experience working at hedge funds. Trend following is a big one, or at least breakouts. Typically, hedge funds are looking at much larger time frames. They're not down at the 30-second, like I just mentioned earlier. From all my instructors that have been at the hedge funds, they usually wanted us no lower than the 4-hour chart. And that's because that's where the big moves are. And that's where these large hedge funds or any institution that's managing a lot of money, their time frame is usually much longer than ours. When you have a smaller account, you typically focus in on smaller time frames. One, because of risk, but two, also because you want that turnover in your money. So trend following is another big strategy. The next one is mean reversion. Mean reversion is price wanting to revert back to the mean. If it gets overextended either to the upside or downside, it either wants to come back to the average by either dynamically going back to the average or kind of going sideways until it meets the new average the average meets it. But these are typically very high probability wins, but very small wins. I have met many a mean reversion trader. I do have some books that I intend to implement algorithmically on how to do some mean reversion trading. But again, this is another strategy that not unique to hedge funds. It's something that we as retail traders can do. The last one here is high frequency trading thing. There's a lot of retail traders that I've come across that this is what they want to talk about. It takes infrastructure. It takes the ability to execute hundreds, if not thousands of trades in microseconds. It's trying to capture very, very small moves in the market. But that's something that maybe I'll explore a little more. If you've been following along on my blog, one of the things that I'm aiming to do is to get the World Quant University's master's in financial engineering. So I'm sure I'll touch on some of this topic. Outside of pursuing that education, for me, myself, right now, I really don't have an interest in high frequency trading. Know that that is something that hedge funds do. Whether or not a retail trader can do this, I go back to that very first strategy that I talked on, which is the cloud capabilities that are available now just might make this a possibility for us to use high frequency trading in our trade. So those are the most common strategies that I've found that are used by hedge funds. Next, why do hedge funds use these quant strategies? And it's risk management. I say it's we're blue in the face because that's what was beat into me. And I firmly believe that it is the truth is we are professional risk managers first and foremost. And being able to manage your risk is what ultimately makes you profitable in the long run. With that, quantitative strategies and algorithmic strategies in general, and some of you know I use those terms interchangeably, but these are ready-made ways to be able to trade the market and control your risk all at the same time because you have a computer that's being unemotional, very rule-based, and strictly following risk management parameters. So it's a great way to control your position sizing, control your portfolio diversification, control your stop losses, your drawdown limits, and to understand when it's time to start adapting your models to whatever changes are happening in the market. So how can we take all of this that we just talked about and apply it in our trading? So first one is data-driven decision making. That's something that I've stressed over the course of this podcast, stress over at the Independent Quant as well, is we make decisions based on the data that's available to us. We are not making gut decisions. We are not blindly taking the advice of analysts. We have to support every decision we've made with data, which includes assessing what the probability may be or the statistical significance of that data for our trading decisions. Next, we want to focus on execution efficiency. Once you start getting your account much larger, the use of limit orders becomes more important. Market orders typically give us too much slippage once your account size starts getting too large. But understanding that efficiency in your trading and in your fills, both in and out of your trades, that's something that these hedge funds obviously have to keep track of. They have to focus on where their losses are. That's something that we always have to keep our eye on as we develop as traders. Testing strategies during different market conditions is something that I've talked about on a previous podcast episode and something that holds true here. The hedge funds have professionals doing this, and that's something that we can glean off of ourselves as well because we are professional traders, right? And the last two I'll kind of bring together because I think they're very closely related, which is automate where possible and always monitor your risk. And I think those are closely related because you can automate controlling your risk. And I think that's the beauty of going down this path, right? I've been a swing trader from the very beginning, but dabbled into day trading for pursuit of getting funded. But the eval that I'm doing at the moment as I'm recording this allows swing trading. So I'm back to swing trading. And ultimately, the goal of that is to trade that algorithmically, automation of all of that from trade execution to monitoring your risk to controlling your risk. That's something that we can learn from these large funds that can be easily applied and should be applied in all of our trading. So ultimately, it's learning from the best, right? We want to learn from these folks that have to do this for a living, are held accountable by the investors that have given them money, their money to trade and to grow. Hedge funds typically charge a hefty fee to manage these folks' money. You have to be a qualified and sophisticated investor to be able to even give them your money. So their approach, there being the hedge fund's approach to all of this money management, has to be top notch. And just because they're maybe trading tens of millions, hundreds of millions, billions, or trillions of dollars doesn't mean that what they're doing is detached from what we're doing as we're trading either tens of thousands of dollars or hundreds of thousands of dollars. It is directly applicable to us. At the end of the day, it's mathematics. It's mathematics in the execution, but there's also an attitude of professionalism and protecting the income and the money that for you and I, this could be our life savings, this could be our retirement. For the most part, I trade my retirement. So it is, how do I ensure that I don't blow up this account so that 15 years from now I can actually retire, right? It takes that level of professionalism and care to say, I am going to follow these rules. I'm going to trade as just like these large institutions do, with professionalism. So if you found joy in that or found value in that, head on over to the Independent Quant, sign up for our newsletter. Our site at the time of this recording is going through some big changes as I'm migrating to a new service. But I look forward to seeing you at the next podcast or whatever other functions I'm having at the Independent Quant. Until then, traders, keep it green.